Hey, everybody, welcome to week 41 of 50, Infinite Banking, subtitled Show Them Your Math. Nelson Nash created this concept in the 1980s to use whole life insurance as your personal banking system. It was from the US. A lot of people question whether it applies in Canada and does it work in Canada. But policy loans are taxable above the adjusted cost base in Canada. That's different from the US and critically important. When I started preparing for this session, I felt angry that advisors were promoting this without understanding the math. Now I think I was wrong. The concept is worthy of consideration. The product has evolved, costs have reduced, better cash values, innovative design. So today's question, does the math support it for your situation? Is it something you should be showing to folks? So our role is clear. We optimize product implementation after allocation is determined, not before. And we can't optimize until the allocation is determined. So, step one first is permanent insurance allocation appropriate within comprehensive planning? TFSA maxed, RSP optimized, high interest debt addressed. And then we come to step four. Once allocation makes sense, how should it be implemented? That's where infinite banking gets evaluated against alternatives. Foundation first, product optimization second. And here's something I saw on the internet. If you typed in, at least in my Firefox that I use, I typed in Infinite Banking Canada. And the first that came up was from RBC. And it was Michael Kirkpatrick. He has optimized infinite banking from a business perspective. He has taken the concept and used it to help people engage him. And it's brilliant. I remember he was with our tribe for a while. And product optimization comes later, but he is doing this picture you see here of the integrated planning, and he's using infinite banking as one of the tools we offer as a way. So I don't think it's critical. I think there's clarity in finding what you can to introduce consumers to a particular topic that they may be interested in. So when we look at this and we ask the question, this policy loan stuff, why? Why don't you just do withdrawals? Don't they work? And there are different access methods, and withdrawals are taxable. That's one of the issues. And the way it works from a tax perspective is maybe bank loans avoid tax. ACB can be preserved for future if you choose. You can repay loans and restore ACB. So interest deductibility, it depends on use, not source. Investment use, both deductible. Personal use, neither deductible. So that's paragraph 21C of the Income Tax Act. But why don't we just pull out the money? If we're using a bank account, we could pull the money out and put it back in. So here's a complete access comparison. I call it accessing the cash value, walking through all the choices. And you can see at the bottom, on death, tax-free. Isn't that great? But this is a more complete picture. I've looked it up and I hope I got it right. But policy loans are like 6 to 8%. Bank loans, 7.5 to 9%. Policy loans may be cheaper initially, but they're exhausting the ACB eventually, triggering future taxation. So we're going to talk about pool mechanics. Your interest doesn't come back to you proportionally. It goes into a par pool, dividends calculated by actuarial formula based on overall pool performance. The trade-off, though, is, you're saving 1 to 2% on interest perhaps now, potentially lose tax-free access capacity later. But you can do the math for your own timeline to see if anything here in the infinite banking concept is worthwhile. When we talk about policy loans, here are the top 5 disclosures. There's 5 realities consumers must understand. Number 1, it's tax-free only until the ACB is exhausted, typically 20 to 30 years, not forever. Again, it gets replenished if you actually pay back the loan. 2, interest goes to a pool, not back to the client proportionally. This is mutual insurance, not being your own banker. 3, reduces the death benefit dollar for dollar by outstanding loan amount. Pretty obvious, right? 4, interest rates can change, not locked in over a 40-year timeline, as can the performance of the underlying product. And number 5, repayment is optional, but discipline is critical. No enforced schedule means you must self-manage rigorously or have an advisor who got paid the commission at the beginning help you with your future decisions. These aren't reasons to avoid policy loans. They're realities to understand before committing decades of capital. Here's an analysis, a real case I did. Actually, this came out of something that I read online. I was looking for somebody online talking about infinite banking that actually gave us a situation to look at. And in this case, we had a situation where a 35-year-old was putting, they said 10,000. I upped it to 100,000 a year for 10 years. And then you can see there's cash value. What's interesting is you can borrow up to the ACB without any tax. Now, you can't borrow the entire amount because they're going to let you get 90%. They're worried about interest. But for this purpose, I said you got a lot of insurance. This 35-year-old is looking at the fact that in year 10, there's $1 million of cash value, $1 million of ACB, and they actually do a loan, end of year loan of $971,000 in this case as a policy loan, and I don't repay it. The spreadsheets can go a number of different ways, but this to me is looking at it as a worst case scenario kind of approach. I mean, obviously it can be worse. We could run the numbers at current -1. We could raise the loan rate to 12%, but to as a starting plate, make the variables variable, pay it back if you want. But what if you didn't? And then what I see is in year 18, you can see the ACB is going down. That's the tax-free amount you could borrow. The cash value is 1.8, but the loan is now exceeding it. You're done. The policy's completed. And I looked at the IRR and it's, see the bottom right corner, -1%. So what does that say to us? It's something to look at. Perhaps the client would look at this and say, you know what, worst case or a negative case ain't so bad on my circumstances. Could I do better over the next 18 years by putting money into a term policy and a TFSA? Absolutely. But there are different benefits and features with this approach. Maybe we can do even better. Maybe the new rules allow us to construct products creatively, like Manulife's example that's so incredible right now, that you can actually do better than this, even though this is a situation where success didn't happen, in my opinion. Pool mechanics, the truth about paying yourself. No, the interest is going into the participating pool. Insurance company invested professionally, pays claims and expenses, calculates dividends from actuarial formula. That formula doesn't track your interest back to you proportionately. Dividends depend on overall pool performance and your policy's characteristics, legitimate benefits, professional management, risk pooling, mutual structure, guaranteed loan amounts, but it's different from having your own personal bank. I looked at the pool visual. What are these pools? I couldn't find a good picture for it, but the money flows in, your premiums, your interest, everyone's contributions, the investment returns. Money flows out. There's claims, there's expenses, there's dividends, there's surplus, there's lapses. The dividend formula determines your share based on policy characteristics, not individual contributions tracked proportionately. So what are we going to do? We got to compare it to something. What do we compare it to? After 9 slides of all this technical disclosure, this is a critical question. What are we comparing to? What are the alternatives? Not, is infinite banking good or bad? Wrong question. Right question. How does it compare to realistic alternatives using transparent measurement? We're not for or against infinite banking. We're for transparent analysis. When I started preparing, I was angry. I was wrong. The concept is worthy of considerations. Product evolution, reduced NCPIs, better cash values, makes it more viable than 20 years ago. Specialists like Scott Cordier have done brilliant diagnostic work on the product. And our role, show the math, let families decide. Here's my hierarchy of approaches. This pyramid shows our industry's evolution. At the bottom, traditional approach, policy illustration, sales technique, show concept, close sale. Show concept, close sale. The middle one, I call it the benchmark approach. What it does is it compares to alternatives transparently. We measure everything using identical assumptions. We put everything in writing. The top one, broad concept, that's estate planning specialist. That's the foundation first. That's where we start. Product optimization comes when timing is right. We didn't invent this hierarchy. We made it visible. It includes things like, ready for this, the diversified portfolio approach. That evolution enables proper infinite banking evaluation through measurement, not marketing. So here's the final slide. Class 41. 41 of 50. We got just another 9 left. Infinite banking. 5 things consumers must know. Number 1, this allocation decision belongs within comprehensive planning. Foundation 2, foundation first. Number 2, policy loans are tax-free only until the ACB exhausts. Typically 20 to 30 years today. Okay, point number 3, you're participating in mutual insurance pool, not being your own banker. Number 4, you got to compare it to realistic alternatives transparently. Sometimes infinite banking wins, sometimes it doesn't. And number 5, implementation requires specialist expertise. Can they project your ACB timeline, explain pool mechanics, build repayment discipline, compare alternatives? We don't tell families whether infinite banking is right. We show them how it compares using transparent measurement. If it's optimal, the numbers will prove it. If not, the numbers prove that too. That's transparency. That's professional practice. Okay? Questions? Join us every Thursday for the full discussion. We're going to join the group now so everyone can tell me what they think of the top 5 of this week. Thank you, guys.